Hi everybody and welcome back to video number 3 for chapter 4 in merchandising inventories. And here we're looking at the closing entries for merchandisers. And initially we do this very similarly to the way that we did it for our closing entries that we had in the last chapters. And here we're debiting sales to zero that out and crediting income summary. And then for the cost side and the expense side, we'll debit income summary and zero out all our costs and expenses with a credit. And that will zero out the income statement for the next period. Then we close that income summary account to retained earnings by debiting income summary, because in this case, our credits were greater than our debits. So what we would do is just simply debit income summary to zero that out and put that balance with a credit into retained earnings. That's the two-step process. For dividends, we don't need to do a two-step process. We just close the dividends account by zeroing it out here with a credit and moving it a debit, which is a reduction, to retained earnings. Okay. So let's take a look at these merchandising transactions. We're going to purchase merchandise for resale here. We debit merchandise inventory, credit cash or AP. We pay freight costs, we debit merchandise inventory and credit cash normally when it's FOB shipping point, because we are responsible for the inbound freight at that point in time as the purchaser. And then if we pay within the discount period, we'll debit accounts payable to get rid of that accounts payable and credit merchandise inventory for that discount, and then credit cash for the bulk of that payment. And I think if we pay outside that period, we went through that, recording purchase returns and allowances. We're going to show that as a reduction of inventory, and away we go. Same thing with sales. We're selling merchandise. Our standard entry is going to be a debit to accounts receivable and a credit to sales, a debit to a cost of goods sold, and a credit to merchandise inventory. And then if we take the discounts, we're going to show that as a seller. We're going to show that as a sales discount account. Now that's what I call a prompt payment discount. And then if it's outside the discount period, we just simply pay it in cash, or get paid in cash, I should say, as the seller. And if we have a sales returns of defective merchandise, we're going to do two pieces of that. We're going to always remember we not only have to reduce the sale, but we have to reduce the cost as well. I think you all see that. And then we have an adjusting entry here for shrinkage. We'll go in and debit cost of goods sold and credit merchandise inventory. But our closing accounts, we went through that a few seconds ago. That summarizes our closing entries. Okay, there's no change in closing income summary and dividends then. All right, let's take a look at preparing multiple step and single step income statements. Here, I'll move this down a little bit. Can I do that? Maybe not. Okay. Here, we're going to define, we're going to look at this multiple step and single step income statements. And what we have is a multiple step income statement. And here we have a great level of detail. We show our sales, sometimes called gross sales. We back out sales returns and allowances and sales discounts, and we get to net sales. Then we subtract cost of goods sold from net sales, we get gross profit. Then we have our operating expenses. We normally distinguish between the selling operating expenses and the G&A operating expenses. And that will give us our, when we subtract that from gross profit, we'll get our income from operations. And then we have some other non-operating gains, losses, revenues, expenses. And we subtract those or add those as the case may be. In this case, we added $2,000. And the bottom line here is net income. Multiple steps. So we have all the pieces that are easily seen. With a single step income statement, here we summarize. We show just net sales, but we bring that interest revenue up under revenues. That interest revenue was clear down here in the multi-step income statement, but we bring it up into the revenues section of the single step income statement, and that's gain down here as well. We're going to bring that little beauty up here under the revenue section, and we have total revenues that way at $318,200. Then we back out our cost of goods sold, selling expenses, G&A expenses, interest expense, and our total expenses were $303,000. We still get the same net income, $14,900, as we did here with the multi-step. But there's far less detail, as you can see in the single step. Pretty simple, right? Classified balance sheets. All we mean by classified balance sheet is we put those balance sheet items into things like current assets, long-term assets, current liabilities. We have categories, basically, classifications, I should say, of that balance sheet. And that's all that means when we do a classified balance sheet. Here we're just looking at the current assets. And the current assets, our key ones are cash, accounts receivable, inventory, and prepaids. Here we had some other inventory of office supplies and store supplies. And so our total current assets are shown. We list them in a specific order, and that specific order means that we're more highly liquid assets are shown towards the top, and as we go down, it's less liquid as far as being able to be converted into cash. The slower it's converted into cash, the less liquid that asset is. All right, every chapter has its analytics, and we have our acid test ratio here and gross margin ratio. These are very easy. You'll remember current assets are current assets divided by current liabilities. Well, for the acid test, or quick ratio as it's sometimes called, we only use the quick assets. And what are those little beauties? We have cash, short-term investments, which is all the same as cash equivalents, sometimes called, and receivables. And then we divide that by current liabilities. The rule of thumb here is around 1. That's if you have a ratio of at least 1, they're pretty much unlikely to face liquidity problems in the near future. And current assets, usually the rule of thumb is 3. Current ratio is 3 to 1. Okay, so here's some examples of Nike's acid test ratio. And as you see, its acid test ratio is getting worse. It 2 years ago was 1.8, but it's deteriorated a little bit, as has its current ratio. Under Armour, on the other hand, has gotten a little better on acid test, but a little worse on current ratio. I've always thought for the last 5 years that Nike would acquire Under Armour, and so far I've been wrong. So it seems like a good fit on paper, at least to me. Anyway, acid test ratio, really easy. Gross margin, used extensively in the real world, and all we do here is take our gross profit, which is net sales minus cost of goods sold, and divide it by net sales. So gross profit divided by net sales is your gross profit margin ratio. It's really a percentage, not quite a ratio here. If it was a ratio, it would be 0.447, for example. But they show it properly so as a percentage. So I'll pick on McGraw-Hill a little bit for that, but nevertheless, it's common vernacular in the business world to call it a ratio. And very important one. We look at this quite often. And here we can see that 2 years ago it was 44.6. It went down a shade a year ago, back up to what it was a couple of years ago. Looks pretty good. And it represents the percentage of dollar sales available to cover expenses and provide a profit. All right, let's take a look at Appendix 4 Alpha. And here we're going to be looking at both the periodic and perpetual inventory systems. For your exam, you can use the page from the book that has these illustrated on it. I don't want you to have to memorize all this, but I do want you to understand what the differences are. So in the case of we went through the perpetual inventory, but here under periodic, remember, we're not going to know what those inventory amounts are going to be until the end of the period. So we're just going to show purchases here under periodic inventory and not bring them into merchandise inventory yet. So you won't see a purchases account on a perpetual inventory system. Under the periodic, we're going to show purchases discounts instead of reducing inventory at this point in time, because we don't know what that's going to be yet, that inventory. And so under periodic, we have the same as perpetual under that example. And then under this example, our $30, that was a purchase return and allowance, and we reduced inventory here under perpetual inventory, but we're showing it right away in the purchase returns and allowances area. So then under the $50 that we had for the allowances, we do the same thing. We show it right away to the purchase returns and allowances, whereas we reduced inventory under a perpetual inventory system. Under periodic, our transportation in shows a $75 amount, whereas perpetual, we adjust the inventory up by $75. So I think with a little study that will become a little more obvious. And then if we make a sale now under periodic, we have no difference basically here under the revenue side, but there's no cost side entry. We don't know what that cost of goods sold is that we do know under perpetual inventory. And then under a perpetual, we have no difference here under the sales side, but again, we don't show the cost side here. And lastly, under periodic, we have no difference here. All right, that looks like a good place to stop this video, and when we return, we'll take a look at these closing entries.